Welcome to the Gray Report. I'm your host, Spencer Gray, and thank you for joining us for this special Christmas and holiday rendition of the Gray Report, joined again by producer of the show, director of communications and marketing here at Gray Capital, Matt Bossnagel. How we doing, Matt?
Pretty good.
Man, we had the Gray Capital holiday party last night. It was a little bit of a rager. It's a good time, prizes, all kinds of good stuff, but we're back in the saddle before the holidays, and what everyone wants to know is multifamily, is CRE. Are we getting presents under the tree, or are we getting lumps of coal?
I think, you know what? I think that we've been good.
I think so. Well, we're going to get into that. What's in stake for multifamily for 2025? Get some new reports just after we released just a bombshell forecast last week. Pieces from Freddie Mac, IPA. Where else, Matt?
Cushman and Wakefield.
We
got RealPage and Trep.
Man, some of the best sources we got.
Yep.
All right, you're going to want to stay around and watch the whole episode. Make sure you like this video and subscribe to the Gray Capital YouTube channel. Let's get into it. Welcome back to the report.
Hello.
Matt, I'm excited. Again, it's the holidays. We've got Christmas music playing in the office. It's a little bit slow today.
Yeah.
Have you noticed?
Yeah. I think some CRE offices, they get a little slow around the holidays. We like to keep working,
Yeah, steady Eddie. Yeah. We got folks that are on site. I think we're delivering meals at a couple properties, so a lot of folks aren't in the office, but still kind of cranking it out. And we're still on the hunt for deals because even though interest rates they're still high, 10-year Treasury way higher than we want it to be right now. 2025, I think, is going to be tougher than what a lot of people think it's going to be.
Yeah.
But I'm still very bullish on like the medium and long-term prospects for multifamily.
Yep.
And so, I almost think that this environment that we're in right now of all of a sudden uncertainty, because last week the Fed's press conference, FOMC meeting in the Summer of Economic Projections, I believe is going to appear to be an inflection point, but I think just for the medium term.
Yep.
And it's going to throw some shade and confusion over the next year or so, at least until we see some really concerted, just concrete data, which I think we are going to see, because I think shelter inflation, as we've seen rents decline over the last 2 years, that's going to be seeping into CPI and inflation numbers. And so regardless of, or it will be a counterweight to maybe some other inflationary pressures driven by strong growth from the economy, tariffs, any of the other kind of inflationary policies that may come through the Trump administration, in addition to the growth policies that may happen as well.
I think that that has been a lot of discussion in this on LinkedIn, especially, and it's this was actually from Paul Fiorilla. One of his comments was like, "It seems like LinkedIn is full of economists that are calling for interest rate increases."
Yeah.
And I think, and this is what I said during the outlook. It's like, if you look over the long term, and I'm talking past like the past, let's discount the past 3 months of small incremental increases in inflation. Actually, the big story of inflation is that it is gradually decreasing.
And I think that long-term trend is going to continue. And so what I want to take advantage of is, we had buyers that were getting ready to get out the sidelines because, the 10-year Treasury was below 4 a couple months ago. We had sellers who were thinking, this is going to be a great time to sell in 2025 because prices are going to be lower because interest rates are lower. That means I can get a lower cap rate. But if Treasuries aren't lower, they're actually higher than they were a couple months ago. All of a sudden, you can't get those valuations. And so we had a lot of folks, whether they have a loan maturity or not, who they were just maybe hoping on selling this year. They're going to have to make the decision. Am I going to hold it out for longer, or am I just going to have to stop throwing good money after bad, and I'm just going to have to cut a couple of these loose? Yeah. I think some developers may just have to come to that decision where they're just going to have to cut some of these deals loose. So the way we're seeing it right now is, all right, this fear from owners and buyers, because the buyers are like, I don't think I can raise any money maybe with interest rates, and I don't know, I'm not sure how the deal looks. I think that's going to create a huge opportunity. Less buyers, maybe some discounted pricing, which we're going to get into some of the TREP numbers and showing that prices may still be going down a little bit in multifamily. And where you don't know, you just don't have a crystal ball, but treasuries are high today, but in 3 months from now, when you might be closing on a deal, those treasuries may have fallen. The deal's got to work today or with even higher rates, because it could could keep on climbing.
Yeah.
But, there's some potential upside there.
I don't think that there was false optimism this time last year. In fact, I think there was lots of calls for like recession, and it was.
Yeah.
But this is around this time of year is a lot more realistic assumptions, I think, about where the economy might be going. Maybe it's not crazy growth, definitely not recession, but it's not like, all right, now it's time to thrive in 2025. It's going to be work that you need to do in order to make money.
Thrive through 25.
And
again.
you talked about coal and presents under the Christmas or in your stocking or whatever it is. I think that remains to be seen. That may come, in 2025 as the increased pressure from interest rates means that a lot of people's assumptions, which was for like a big drop in interest rates, that if that doesn't come true and if rent growth doesn't come true, then they got a lot of coal.
Yeah, I mean, if you think about, let's say if you're a lender and, you had the base case that rates are going to be much lower in 2025, you're probably telling your borrowers who were maybe a little bit underwater, like, hey, I think you guys are going to be good. Yeah, you're fine. We'll be able to, get this thing turned around, sometime later this year. Now, all of a sudden, they're having conversations of, this might actually not work out. And we're going to have to make a hard decision of, do we allow these borrowers to extend and pretend further, kick the can down the road even further?
That's on my New Year's resolution for guests for the Gray Report next year. I want to get someone in here and have them talk about those decisions. Like, when do you decide? And I'm sure that a lot of it is, probably 100% data driven, but where do they put the data?
It's also relationships.
Yeah.
It's also, what does the bank have capacity to do? Because they don't want to necessarily manage any of these assets. They don't want to take ownership of these assets. So they can work with the sponsor who might know the property better than anyone else to see if they can get it to a point of where it can be sold, or do they force a sale? And that's where those relationships and the strength of the sponsor then comes into play.
And I think this is relevant to talk about, not just in the context of like a wave of loan maturities that we have slated and we've looked at for 2025, but even in the context of just like everyday loan maturities, everyday interest payments that you have to pay, there's always a consistent flow of this, and it's something that if you're looking for acquisitions, you look for the loan maturities and you see, all right, are they going to sell or not? But I think that the added pressure of higher interest rates is something that wasn't in the calculus a few months ago, really, even, and now it's
calculus was the assumption of lower rates.
Yeah.
And it's interesting because, again, some of these forecasts are written kind of prior to the Fed meeting, but a lot of the fundamentals really don't change too much because we kind of had access to the data. And I'm just looking at this Cushman & Wakefield report, and it's a little bit of their perspective, on the tide. It's titled "The Tide is Turning" for CRE, and it is a very bullish and positive case. And I don't really have a lot of data, maybe some technical analysis to counter this, but really it's generally positive.
Yeah.
Almost so that it's a little bit scary, because anytime I see anything this positive, I'm like, all right, well, now we're getting to be a little complacent.
Yeah.
For example, they start this piece, the key takeaways: the U.S. economy is growing robustly. It's time to retire the recession predictions. The economic fundamentals remain strong going into 2025. They're not wrong. It's just, the time to retire the recession predictions. I mean, again, like, there's going to be a recession at some point. It's just a matter of when. The only data that I can see, more on a technical basis for a recession, is this idea of the yield curve uninverting or reverting, and where the longer dated maturities have been yielding less than the shorter term maturities, and so it's upside down. And so as that yield curve reverts, and where the 10-year will be higher than the 1 month, and
which is where that's where it's supposed to be. Right?
That's where it's supposed to be. But usually it reverts because we're entering into some sort of slowdown or recession, which is causing the Federal Reserve is lowering those short term rates. And so then immediately, the long-term rates stay here, they're fluctuating around, but they have the mandate by fiat to lower the short-term rates. And that reverts, usually in response to or just before, because they start seeing it coming as it's already happening. some downward or declining growth, or they're going into a recession. Now, the base case here is we're basically in this soft landing scenario where we can gradually lower that and maybe it can revert. But there really hasn't been a time, if you go back into history, where there hasn't been a recession when that yield curve reverted. Again, that's usually because, oh crap, we're in a recession. We lower rates as low as they can go, and it automatically reverts.
Well, if you're looking for evidence that this like record-breaking 10 days of stock market declines, that could be.
Well, and that's what they're pricing in the whole idea of there's going to be higher long-term rates, and that affects valuations. And so Jay, our chief investment officer, and I were having a conversation today. The stock market is a forward-looking indicator.
Yeah.
It's not always right, but it's looking, maybe 6-9 months into the future, and they're saying interest rates are going to be a little bit higher. We can't value all these companies as a high of a multiple based on the discount rate of the 10-year Treasury, and that goes the same for commercial real estate. Obviously, there's some speculation on growth for all of the good reasons that we mentioned on the forecast. We're going to talk about today of supply coming down, and rentals being much more affordable than homes and all of that.
Yeah.
But at the end of the day, it is a financial instrument. It's traded based on the cash flow relative to other sources of cash flow, with the benchmark being, in treasury bonds and the 10-year Treasury bond. And you can't have cap rates so low, sub, around 4% or way below 5%. You've got the 10-year Treasury basically at the same level. You want to have a healthy spread between the two, and not a healthy spread is an indication of maybe you're not getting as good of a deal as you think you are, or you have to be relying on so much future growth.
Yeah,
which that's the crux, because we do believe there is a lot of future growth. But we could be wrong on how much and when.
Yeah, I think that some of even the loan extensions that happened in 2023, and some of the way that people have operated since the market kind of hit bottom, or the market started declining, a lot of these operators or asset managers were operating under the assumption that rates would be lower in 2025.
Yeah.
You're looking from the perspective of 2023, you're like, man, there's got to be some relaxation of these high rates in 2 years. But now that there's not, I wonder what the banks are going to do. I wonder what the borrowers are going to do. But I also think, the multifamily buyers, they're probably in a lot more, similarly skeptical position. I think that this is a time where it's like, get real. I don't think it's panic, but I think that we could have a recalibrated market where where maybe there's more sales activity, which is what I'm desperately hoping for. But the sales activity is not accompanied by an incredible jump in prices.
Yeah, I think, again, they have to be, if there's a lot of sales activity, it's how many buyers are going to show up, and what's their appetite that's going to be. And a lot of the sales activity, what we're seeing, early indications, there's very few good looking deals, and there's a lot of garbage out there.
Garbage, like too high prices?
That and just quality of deals.
Yeah.
all of the above. So again, just back on a highlight of the economy. And again, this is a lot of these reports. Again, they were published prior to the FOMC meeting.
Yep.
If you want to go to check out Great Capitals, our report that was published after the FOMC meeting, you can do that at Great Report. GreatCapitalLLC.com/report, and this is the thank you page for the report. If you can just go to GreatCapitalLLC.com, that's really easy. And then, research report 2025 multifamily forecast. And bam, you can sign up to get the full report. But anyway, as you enjoy us going through.
I did want to know one thing. You talked about like these reports coming in late, and there was a new, it's John Burns and I think CRE Daily. And this was one that I was desperately waiting for. It was about investor sentiment, and they're tracking as of November, which is a really like near term improving sentiment, basically.
Yeah.
So this is probably after the election.
After the election, Trump's in there. Good. Inflation's going down, but
positive progress on investor sentiment.
And I think that there is still positive progress, but I think that there's just there's some storm clouds. I think some folks that are, again, we've talked about this time dilation. I think that it's just we're taking a longer time to get out of this than everyone would like.
When you approach a black hole, we approached it. We didn't get there though, which is fortunate.
Pandemic. Again, some of these are a little slightly outdated, but again, real GDP is growing at 2.6. That is at a healthy level. Job growth, continue to add jobs. Unemployment is low. The Federal Reserve is calling for even lower unemployment somehow.
Yeah.
PCE 2.5, not too far away from the Fed's 2% target, even though this PCE versus CPI, wage growth, solid. So again, all the fundamentals are really good. I mean, and then again, more favorable commentary. The U.S. economy is in the sweet spot. The report continues, and again, you can read the whole report, but I'm not going to read you the whole thing. But if you've signed up to the Great Capital newsletter, greatcapitalllc.com/newsletter, you're going to get this sent to your inbox. Property sector gaining momentum, and I'm reading these headlines just to kind of get the sentiment of what Cushman and Wakefield, which is in the business of selling real estate, is in. And I think it is my takeaway is that none of it's wrong, but it is a little bias.
Yeah.
Because there's no.
They don't want to tell you.
They don't want to tell you, but maybe not. Maybe now is not a good time to buy.
Yeah.
CRE prices have corrected, meaning that they're starting to rise again. Looking at this TREP piece.
But I don't know.
I mean, right now.
Yeah.
It's not necessarily the case. Quarter over quarter, multifamily value-weighted index is down 2.53%. Year over year, down 8.3%.
And that's TREP.
And this is TREP. And then kind of peak to trough, the way they're calculating it, we're down basically 17%. So, I mean, you could say that we're in the trough.
Look at that line in the Cushman thing. They're kind of spinning it a little bit as like prices have corrected, but that line looks awfully flat from like May 2023 to September 2024. Even a slight decline. Yeah. So corrected or maybe normalizing or flattening or something. I'm not sure how much of that line, that slight decline, is due to office prices. But if you look at TREP, at least in the past year, one of the biggest declines, if not the biggest, was multifamily prices. And I also would caution, like, that's not the sign of an emergency or a crashing market. I think it's hard to get good numbers when sales transactions were half of what they were before the pandemic. I just think that it is, like I said, it's a time to get real.
It's also the calm before the storm.
Yeah.
Or, it is also darkest before dawn.
Yeah. Well, and I'm not. That is true. It's like low prices. Well, that makes buyers hungrier, and I think that buyers may be more excited to enter into the market now than if prices have been like steadily climbing.
They are. I think the challenge is, with tepid at best rent growth, and not getting rent growth in the first year or two, can you accept lower cash flow and non-compounding growth to take advantage of a low basis today, because you're assuming and speculating, and I think it's probably correct that there's going to be a lot of rent growth in 2026 and beyond. And
that's where I'm going to plug and promise to one of the next reports that we do. I want to look at some of these markets, some of the markets that we're following, and maybe throw in a couple contrasting markets. But I think that next year is going to be a time where we see a lot more divergence among the markets with a lot of apartment supply and the markets with like moderate or low supply, because the markets that have built a lot this year are going to continue to be building in the next year or two.
Well, speaking of that, let's just jump over to this RealPage piece, because that's a little bit about what it's talking about, specifically with A-class units, talking about Class A premium, is the smallest in high supply submarkets. And this is really touching on your point, Matt, that supply is the canary in the coal mine a little bit.
Yeah.
I mean, that's kind of the biggest piece of evidence. I mean, even in markets where we're seeing incredible demand, tons of absorption, those are often not always in the markets that are seeing the highest level supply, and the supply wave is outpacing demand, and you're seeing negative rent growth. So give us a quick, summary. What's the piece from Dustin Weaver, who I believe joined the RealPage team recently. So Dustin, welcome to the RealPage team. Welcome to come on the Great Report anytime.
Oh, for sure. So basically, these apartments that have had a lot of nice new apartments, all of a sudden, the price of the kind of B and C, like less quality, not quite so nice, those rents went down too. And the markets, again, with the highest supply, have smaller gaps, which is it's almost like there's this steadier balance between the different types of apartments in a market. And I'm always interested in some of these, like, you can draw the line one way, but sometimes it's not about moving, I'm moving from the nice one to the medium or it's just a nice one to a slightly less nice one. And then maybe you live in a slightly less nice one to a even slightly less nice one. And so there is a very smooth, like, we've seen so many apartments where, it's hard to kind of categorize. It's a fuzzy line. There's no like standard of you have to do this to be Class A. Yeah. So some of them, that are a little less nice, and that has happened. I'm surprised at how quickly and how effectively that's happened, because a lot of times there's different economics of Class A renters versus Class B or C renters too.
Yeah,
but
I think that all tracks, and even more so, I think it's a counter to the narrative that all right, developers are only building luxury apartments. And,
really good.
And that's not that's what we need. We need you to build workforce housing, and it shows, and I think it really proves in many cases that supply is the answer, kind of supply of anything. And if we could afford, and if it was economically feasible to build B-class apartment communities and deliver them at like $130,000 per unit, or really you'd want to be around $100,000 per unit, but that's just not like the reality. To be able to build something that cheap, to be able to have the rents low enough, it doesn't work that way.
And I think it also speaks to renters responding to a lot of these things, whether it's concessions or just the level, the rent level. Like,
at some point,
it's a different industry than it was like 10, 15 years ago. Now they can shop and they know, and they seek those out and make those decisions lightning quick. Whereas before it was a little bit more hidden. You'd have to walk to everyone, and maybe there was a gap.
And also think about we're talking about B and C apartment communities. What's been happening at those communities the last couple of years? People can go in, syndicators buying them, fixing them up, pushing the rents, and with an idea that the new property down the street is going to be coming in at several $100s above. Or we're going to be moving our rents, so we've got some space. We've got some like a gap between. Our rents are going to be higher than they were. We're going to raise rents to $250, but we're still be $250 below. Yeah. But then all of a sudden, that newer property, they lower their rents or they give a concession. So then there's no delta. Then that B class property has to then lower their rents because they can't have rents that are the same or higher than a objectively nicer, newer property. Yeah. And then so it all kind of flows through and on the margins. Yeah. And then it not only gets down to Class B, but the same thing with Class C. And so it filters down throughout the entire market.
It was interesting seeing the different rent growth paths during the pandemic, where sometimes there was times when there was these periods where Class B and C rents would grow a lot more quickly than Class A, but I think that the dominant force of apartment supply has really guided all of these kind of a little bit lower.
Yeah. Well, and on that, I mean, the renters and consumers are being a little bit squeezed right now, even though like wages we saw are growing. I mean, it's off of a couple years of inflation, outpacing wages, specifically in different categories at different time, whether it was housing back in 2021 or food and, all kinds of lumber back in 2020 and 2021. Yeah. So a lot of those prices have come back in place, but most of them, maybe the rate of growth has come down, but the prices haven't themselves come down. And housing is expensive. Everything's expensive. This report, though, from RealPage, or no, it's not from RealPage, it's from Freddie Mac, goes into breaking down, expenses for homeowners versus renters. And it was a little bit of a surprising result. I think that really renters still are the most cost burden, even in terms of shelter. And renters out there, everybody is somewhat more cost burdened than they used to be. And that's where a lot of operators are running into resistance and headwind when they're trying to push rents, because it's just, I think in some cases, folks can actually afford it, although this would show that it's on the edge. Sometimes it's like, guys, you've raised the rent $100 3 years in a row. Give me a break.
If you pair this with the enormous rent to income, the gap between, not rent to income, the gap between home ownership costs and rental
Yeah.
costs. And it's funny too, because Freddie Mac last month, that's what their
Yeah.
focus was on,
Yeah.
how much more expensive it is to own a home than to rent one of similar size. And if you pair that, the fact that renters are spending more on housing than homeowners, and that homeowners are more expensive, it kind of implies a bifurcating, like a little bit of a demographic bifurcation, where it's, I don't want to say haves and have-nots, but there's this gap between home ownership and rents. And I don't understand why the renters are spending much more in housing when it's home ownership costs that have gone up so much more than rents. So it's a little bit of a mystery, and it does kind of imply a gap between those two groups.
Yeah.
I think though that
you are seeing. Again, non-mortgage expenses versus mortgage expenses. Diverting quite a bit. Look at this graph. Definitely taken away quite a bit.
And I wonder, for homeowners, there is I think a lot of them probably have mortgages still. They enjoy the lower rates that were around in 2020 and 2021, and renters kind of didn't get that, even though I think what Jay said a few weeks ago on the Gray Report, I think really has kind of changed my thinking about it, about rent growth. Yes, apartment supply has been a pressure to lower rents. I think part of it though is communication from the market, from renters themselves, we just can't pay that rent. And if that may happen, I'd pay close attention to household growth and seeing, are these renters, instead of deciding, they're not going to decide not to rent, they're going to decide to be roommates with someone, which would maybe depress household growth. So all I have to see, I think household growth is really volatile anyways, but that would be my assumption, is if push comes to shove, you lower household growth and that lowers demand. And we will see lower rents maybe, but this is the counter pressure that we're looking at.
What's interesting is I think we're getting, and there's a little bit of anecdotal, but we're getting pushback. I'm thinking about a couple of properties. We're getting pushback on price, but when we do our market studies, we talk to renters. There's in some cases, we are still the best price. Yeah, and you're not going to find anything for less, and so, which is frustrating. And so sometimes the pushback comes before the research is done. Yeah, and being look, you guys are raising rent again. It's had the rent increased last couple of years. But the reason for that is because that's just where the market is, and everyone else is there now. It's the question of, do you fight for renewals, and how much do you take the chance of getting a new resident there versus maintaining occupancy? But, I know depending on where those renewal rates are, or how long folks have stayed in their lease, and if they've been, kind of brought up to market or not. Sometimes there's a big gap. But that's where there's a lot of flexibility of right, we get a little bit of increase, less loss to lease, but, do you bring those folks fully up to market, or you accommodate to get a little bit of increase, but they stay there and you don't lose any occupancy.
Yeah. It's interesting, but it's definitely something to keep aware of. This is a reality check, I think, along with the TREP thing. It means that you're going to have to work for it. Yes, there is housing demand, but also we have been, and I think that we've been pretty close to the affordability issues, even among renters. There was a couple weeks ago, there was a Harvard Joint Center for Housing Studies. It was a study on housing costs and housing affordability, and it may have been among renters, and they said that increased even more. However, it's they increase at maybe an absolute level, but when you're talking about percentages or something like that, it didn't. It's a little bit fuzzy. Things aren't going really, sadly, I guess, in terms of housing affordability, but very little progress is being made. If you can fudge these numbers a little bit, that just means that they're pretty close to growing. And I'd like to see housing affordability increase, right? I don't want it to be unaffordable housing, and we've talked about this before. And the solution is building more apartments. However, the interest rate environment means that we all know that that's not going to happen for a couple of years.
Yeah, because that equity financing really has not come back to development. I think it may start here because I think there is a strong case for it, but it's certainly not available today like it was a couple of years ago.
They're still affordable apartment markets in the Midwest, a lot more affordable than some of these sunny beach places. So if you're a renter and you want to move, please consider moving to Indianapolis, where housing costs are low, sun's shiny, you get 4 seasons. It's beautiful out here.
It's nice. It's nice in the Midwest. Matt, do you have any? That's kind of the last article for the report. This has been a great year for the Gray Report.
Yeah.
I just want to do maybe a couple before we cast off.
Mm-hmm.
I want to do a couple just highlights, not just for Gray Capital, but I want to highlight the YouTube channel, which again you could subscribe over at Gray Capital. Or just search Gray Capital on YouTube, and because we've had quite a bit of subscriber growth
for most likely the live
this year, which is awesome. We're right now up to 8,300 subscribers, Matt, which has been awesome growth. Let me see if let me share this real quick. Everyone can see behind the scenes. You don't have the black mode on, dark mode. That's the way to go. But let's look at some analytics just to show everybody a little bit of our growth. Again, I think 600 some videos that we have published since inception. We got so far this month. What can we do? 28 days. Let's do 2024. 2024. Matt, now we do some advertising. We do some advertising for when we're raising money for a deal. Mm-hmm. We'll run some ads, and some of our apartment communities we also do some ads. So there are some paid views in this list. But man, Matt, 1.5 million views this year.
That's pretty good.
That's 343% more than 2023.
Yeah,
and we did video ads in 2023 also.
Yeah, one of the things that I'm proudest of is our consistency. We're putting these out every week. More or less rain or shine, and I think that I think that our niche right here, covering the news and covering the reports and covering kind of the large discussions that are happening of the moment, has been it's been really helpful and interesting, and for me as a producer. But I also like to think that's a good niche for us. There are other channels that you get a lot of interviews and you get a lot of, okay, how did you get started, or you get a lot of educational things that are okay, how do you do this? Now we do that ourselves a lot, but consistently, I want to aim at an audience that is interested in what's going on and in the current trends. Really quick, this data that we have, sure, it pays to know what an IRR is or what a cap rate is, but it also pays to know which markets are growing and which ones aren't. Like we were saying just last week in the Outlook report, Phoenix, for example, if you didn't know a whole lot, you'd think, all right, Phoenix, great growing market. But then, maybe if you follow the Gray Report, you'd understand that they're building a whole lot more apartments in Phoenix than they can handle at the current moment. So just to get that kind of time, and it's always exciting, when the Fed has a good announcement and we can do some rhetorical analysis of Jerome Powell. But separate than that, just as a general note, it's been fun to follow the news. And I do think that, over the past 4 years, the issue, not just maybe in a broader way than multifamily housing, but housing in general, has become such a larger topic of discussion for everyone that it's made this as news. The newsworthiness, it's just this insider niche, which I will admit, it's maybe a smaller niche than Mr. Beast.
When I listen to Bloomberg or the experts, and the talk right now is and as it has been really for the last year and a half, is what is shelter inflation going to do? Yeah, what's going to happen with rent rates, and how is that going to filter through? And if that small niche is the tiller tab that is moving the larger ship that is the U.S. economy and the global economy, I think some of the insights that we talk about every single week, not that we get everything right, but the fact that we are close to the source from literally and figuratively, from the experts that are writing the reports, regularly coming on the Gray Report, just continually focusing, covering their content that they create. but also the fact that we are an operator and we do have boots on the
Yeah.
ground, and we have, real life experiences and are understanding some of the dynamics that are going on, in real life.
That's another good point. Yeah, over 2004, especially. I mean, a little bit in 2023, but over the year, I have appreciated so much learning from the experiences of the property management team at Gray Residential, and just like how much they share about, whether it's things that are happening with renters, whether it's things that are happening in terms of like their human resources and like managing people. But like, man, we were talking with someone earlier, and we kind of describing our company, and I wanted to say something about Gray Residential and property management. Man, you live your whole life. You live your whole life in this apartment. These people are living every single day. It's their good days, it's their bad days, and it can be a tough job, but it can be really rewarding. And it's really important for people. It's really important for us to do a good job for people, because I think that there are some places out there that don't. And I think that it's easy to see, especially, if you're going on these property tours or something, and it's very easy, and you really quickly, like, all right, we can do a better job. That makes us feel good, but it's also like, yeah, I'd like that to be the standard, but
yeah. If only we could hope.
Yeah.
Try to improve things one step at a time.
Mm-hmm.
Focus on what we can control, and maybe lead a good example for others. Yeah. All right. Well, again, make sure you've subscribed to the Gray Capital YouTube channel. If you have not, we greatly appreciate it. And, GrayCapitalLLC.com. We got a lot of great stuff over there, from the newsletter, which keeps you updated twice a week, to the latest multifamily forecast for 2025. And then once you do that, you'll be on the list to receive all future research reports, articles, and the newsletter from Gray Capital. And if you're an accredited investor and you're considering investing in multifamily real estate in 2025, also get in touch with us, schedule a meeting with the team. We'd love to sit down, have a conversation with what you're trying to accomplish, and see if it's a good fit. We are actively pursuing opportunities in the Midwest, mostly in Indiana, but we're also looking in Ohio, Kentucky, and Michigan. We're based out of Indianapolis, so we'd like to be able to invest where we can be boots on the ground relatively quickly in growing markets that we understand. We'd love for you to be a part of it if it's a good fit, if you're an accredited investor. If not, one day. Let's all try. All right. Thanks again, everyone. Have a great, happy holidays. Merry Christmas. Happy New Year from Gray Capital, the Gray Capital team, Gray Residential, the Gray Research Department. Thank you.
Thank you.
Have a good one.